Offshore accounts. Offshore accounts are bank or investment accounts held in jurisdictions beyond the client's home country, chosen for their lenient regulations and strong secrecy laws. Criminals use these accounts to conceal ownership of illicit funds and transfer money without detection. Funds placed offshore can be held in the name of shell companies, trusts, or nominees, making it challenging to establish beneficial ownership. Money flows through multiple offshore locations to create complex cross-border transactions that evade domestic reporting requirements. Launderers exploit anonymous banking and minimal due diligence policies to deposit large sums remotely. Offshore financial centers often cooperate under limited information exchange agreements, reducing transparency. Criminal networks layer illicit proceeds through multiple accounts before repatriating them as legitimate income. Services like private banking, investment funds, and trust management provide additional layers of protection by pooling assets with legitimate funds. Authorities pursue mutual legal assistance treaties and use subpoenas to pierce the veil of secrecy, but the process is time-consuming and requires cooperation from multiple jurisdictions. International initiatives such as common reporting standards and beneficial ownership registries aim to increase transparency, but enforcement varies significantly. Offshore account abuse remains a popular tactic due to persistent regulatory gaps and the complexity of global financial systems. Layering. Layering refers to the stage in which launderers attempt to distance illicit funds from their criminal origins by executing a series of complex financial transactions. This phase begins once the initial placement of dirty money has occurred. Criminals employ multiple transfers between numerous domestic and offshore accounts. They may purchase and sell financial instruments or engage in foreign exchange trades. These repetitive movements create a confusing maze of transactions that obscure the money trail. Funds might pass through shell companies or nominee accounts operated by unwitting third parties. Layering often involves electronic transfers, electronic payments, and trade invoicing schemes. By constantly shifting the money across different jurisdictions, criminals exploit gaps in regulatory oversight and delay detection. The objective is to confuse investigators and financial intelligence units searching for links to illegal activities. Sophisticated laundering operations use automated software to execute hundreds of transactions per day. Transactions might include round-trip transfers where money moves in a loop, returning to the originator with a legitimate appearance. Each new layer reduces the probability that the original source can be established. Successful layering results in funds appearing as legitimate profits from lawful business activities. At this point, investigators face significant challenges in untangling the financial network and proving illicit intent. Cryptocurrency laundering. Cryptocurrency laundering uses digital assets and blockchain technology to move illicit funds anonymously. Criminals purchase cryptocurrencies such as Bitcoin, Monero, or Litecoin with cash obtained from illegal activities. They transfer these assets through multiple wallet addresses and mix them using tumblers or mixers, which obfuscate transaction histories. These mixing services pool funds from various users and then redistribute them without preserving original associations. Launderers exploit privacy coins, which incorporate enhanced anonymity features, making transactions untraceable. They convert cryptocurrency back to fiat currency through peer-to-peer exchanges, over-the-counter traders, or unregulated platforms. Some use chain hopping to move funds across different blockchains, exploiting variations in monitoring practices. Decentralized finance protocols and smart contracts provide additional opportunities to layer and integrate illicit proceeds. Investigators use blockchain analytics tools to trace transaction flows and identify suspicious patterns, but criminals constantly adapt by shifting wallets and using new services. Regulatory measures such as know your customer rules for exchanges and reporting obligations for large crypto transactions aim to deter money laundering. Jurisdictions vary in their approach, leading criminals to favor regions with limited cryptocurrency oversight. Despite these efforts, digital asset laundering remains a growing challenge in global financial crime prevention. Enhanced international cooperation and information sharing among regulators and law enforcement strengthen efforts to combat money laundering in virtual currency markets. Real estate laundering. Real estate laundering uses property transactions to clean illicit funds by purchasing real estate with dirty money and later selling it to legitimize the proceeds. Criminals often acquire high-value residential or commercial properties in unstable or opaque markets to avoid scrutiny. They may use shell companies, nominees, or trusts to conceal beneficial ownership. Payments for down payments, mortgage fees, and renovation costs come from tainted sources. After holding the property for a period, they stage a sale to a willing buyer associated with the operation. The sale price may include inflated or fabricated improvements to justify the transfer of illicit wealth back into the financial system. Real estate transactions typically involve lawyers, notaries, and banks, which increases the number of potential points for detection but also provides opportunities for collusion. Money launderers exploit weaknesses in due diligence processes by using complex ownership structures and layering funds through multiple jurisdictions. Transactions in luxury real estate markets, where valuations are subjective, are especially attractive. Law enforcement agencies monitor suspicious purchase patterns, rapid resale transactions, and attempts to bypass reporting thresholds. Enhanced transparency measures and beneficial ownership registries aim to curb this tactic, but enforcement remains challenging when cross-border property deals involve multiple legal systems. Smurfing. Smurfing involves breaking down large amounts of illicit cash into numerous smaller transactions to avoid regulatory detection. Criminals recruit multiple individuals to deposit fractions of the total sum into different bank accounts. Each person contributes amounts below the reporting thresholds established by financial institutions and government agencies. This method exploits rules that require banks to report only transactions exceeding certain limits. The funds appear legitimate because each deposit is small enough to escape notice. The laundry operation aggregates these deposits through a network of mules who funnel the money back to organizers. Once combined, the money is transferred to accounts under the control of the criminal enterprise. The process often repeats across various banks and financial service providers. Over time, the origin of the funds becomes obscured, making it extremely difficult for investigators to trace the activity to criminal sources. Technology enhancements have allowed tools for monitoring large deposits, making smurfing more challenging, but it remains a widely used tactic due to its simplicity. Regulatory agencies continue to develop algorithms and risk-scoring methods to detect patterns consistent with smurfing. Financial institutions provide compliance training to employees, emphasizing vigilance. Despite these efforts, criminals adapt their strategies, creating ever more complex networks of small transactions to conceal the origins of the proceeds. Shell companies. Shell companies are corporate entities created with minimal or no legitimate operations and used to facilitate money laundering by hiding the trustworthy sources and owners of illicit funds. Launderers establish these entities in jurisdictions with light regulatory requirements or strict secrecy laws. The companies open bank accounts, receive wire transfers, and hold assets under the guise of legitimate business activities. Criminals route illicit proceeds through multiple shell companies to create complex ownership layers. Each layer adds opacity, making it challenging for authorities to trace the whole chain of transactions. Shell firms often provide false invoices and contracts to support fabricated business dealings. They may list nominee directors and shareholders who act as fronts for the real beneficiaries. International incorporation services, fiduciaries, and law firms sometimes unwittingly assist by filing the necessary paperwork. Authorities combat shell company abuse by enforcing Know Your Customer rules, enhanced due diligence, and beneficial ownership reporting requirements. Despite these measures, criminals continue to exploit loopholes by using trusted intermediaries and frequently shifting company names and addresses. Law enforcement agencies collaborate across borders to penetrate these corporate veils. Financial intelligence units analyze transaction patterns, account relationships, and inconsistencies in corporate records to identify suspicious activity. Effective prevention depends on global cooperation, transparency, and rigorous enforcement of corporate governance standards. Trade-based money laundering. Trade-based money laundering uses international trade transactions to disguise the movement of illicit funds. Criminals manipulate the price, quantity, or quality of traded goods to transfer value across borders. They may over- or under-invoice shipments or misrepresent the type of product exported or imported. The discrepancy between declared and actual values provides a channel for moving money disguised as legitimate trade payments. Launderers work with collusive importers, exporters, freight forwarders, and customs officials to facilitate these transactions. Over-invoicing allows criminals to transfer more value than the actual goods, while under-invoicing enables them to bring excess money back into a market. They might also ship goods with lower quality than declared or reroute shipments through multiple countries before arriving at the final destination. Letters of credit and trade financing instruments further obscure the origin of the funds. Regulatory bodies and financial intelligence units monitor trade data for red flags such as abnormal price deviations or inconsistent trading patterns. They cross-reference shipping documents, insurance certificates, and bank letters to detect manipulation. Despite these efforts, Trade laundering remains popular because global trade volume is difficult to monitor comprehensively. Experts recommend improved data sharing and stronger due diligence measures across the supply chain to counter this form of money movement. Black market peso exchange. Black market peso exchange is a method used to convert US dollars obtained from illicit activities into local currency without direct contact with formal banking channels. Criminal networks operate through brokers in countries with high demand for foreign currency. Dollars from criminal operations such as drug trafficking are delivered to brokers in the United States. These brokers then sell the dollars at a discount to Colombian importers needing U.S. currency. In return, the brokers pay the equivalent value in pesos to the criminal organization using official banking channels inside Colombia. The importers repay the brokers by underinvoicing shipments or falsifying trade documentation to reflect higher payment obligations. This creates an exchange mechanism that avoids traditional money transfer services and reduces the risk of detection from authorities. The process relies on trusted relationships and secure communication channels that coordinate payments across borders. Law enforcement faces challenges because no single transaction crosses jurisdictions, and formal financial surveillance systems record only legitimate peso transfers. Brokers may also provide additional services, such as cash smuggling or front companies, to expand the exchange network. This laundering technique has persisted due to strong trade ties and the large volume of remittances between the two countries. Combating this scheme requires international cooperation, intelligence sharing, and coordinated investigations targeting both brokers and complicit businesses. Cash-intensive businesses. Cash-intensive businesses provide a convenient cover for laundering illicit cash by blending it with legitimate receipts. Criminals acquire or establish enterprises where high volumes of cash transactions are normal, such as restaurants, bars, car washes, or retail stores. They inflate sales figures by reporting higher daily revenue and deposit these amounts into business bank accounts. The launderer supplements actual sales with illicit proceeds, making it difficult for auditors to distinguish dirty money. During audits, the business can present fake invoices, register tapes, and ledgers that support inflated incomes. Cash-intensive operations often use multiple locations to spread out deposits and reduce scrutiny at any single branch. Criminals might also use revolving cash movements, transferring funds from one branch to another before depositing into central accounts. Digital payment methods may be underused to justify large cash deposits further. Inspections by tax authorities and financial regulators challenge this tactic, but sophisticated schemes include altering employee schedules and adjusting point-of-sale systems to align records with reported figures. When authorities suspect wrongdoing, they compare sales patterns with industry benchmarks. Unexplained discrepancies lead to deeper financial investigations. Businesses with poor internal controls and inexperienced staff are prime targets. Despite regulatory measures, this method persists because cash transactions remain hard to trace and easy to manipulate. Structuring through third parties. Structuring through third parties involves using unwitting or complicit individuals and businesses to break down large sums of illicit money into smaller deposits and transfers. Launderers recruit friends, family, employees, or business associates to conduct transactions on their behalf. Third parties perform bank deposits, cash exchanges, or wire transfers, keeping each amount below reporting thresholds. This strategy reduces suspicion on the original criminal and distributes risk across multiple actors. The funds eventually flow to accounts controlled by the criminal organization after passing through successive layers of intermediaries. Businesses such as money remitters, currency exchange booths, or informal value transfer systems provide cover services. Criminals may pay third parties fees or commissions for their assistance. When complicit parties are employed, they may also falsify transaction records, financial statements, or bookkeeping entries. Investigators analyze networks of related transactions, account linkages, and communication records to identify structuring schemes. Integration. Integration occurs when laundered money re-enters the legitimate economy, appearing clean and ready for use. After completing placement and layering, criminals introduce the funds into genuine assets or business ventures. They might invest in real estate, luxury vehicles, high-value art, or corporate shares. These acquisitions provide plausible explanations for large sums moving through legal channels. Funds integrated in this phase blend seamlessly with legitimate capital. Launderers use trusts, corporate entities, and complex ownership structures to mask connections. They hold assets until market conditions favor a profitable sale, thus converting illicit wealth into legally derived proceeds. At times, criminals underreport or inflate asset values to manipulate tax and reporting requirements. Professional service providers such as accountants, lawyers, and financial advisors may unwittingly facilitate integration by preparing documents that meet local regulations. Once assets are sold, the proceeds appear as legitimate earnings and enter personal or corporate bank accounts without raising suspicion. The integration phase completes the laundering cycle, making detection by authorities extremely challenging. Authorities focus on tracing beneficial ownership asset acquisition patterns and discrepancies between reported income and lifestyle indicators. Discrepancies can trigger investigations and asset seizures. Despite enhanced monitoring, integrated funds can be difficult to identify once they are mixed with legitimate financial flows. Bank complicity. Bank complicity occurs when financial institution employees knowingly facilitate money laundering by ignoring or bypassing regulatory safeguards. This cooperation can be passive or active. Passive complicity involves employees failing to report suspicious transactions or neglecting due diligence procedures. Active complicity happens when insiders deliberately alter records, structure transactions, or provide confidential information to help launderers. Corrupt bank personnel might accept bribes or gifts in exchange for facilitating large cash deposits, wire transfers, or trade financing without proper scrutiny. They may override compliance rules to prevent alerts that would prompt investigations. In some cases, senior management ignores risky activities in pursuit of higher profits or market share. Criminal organizations exploit these weaknesses by cultivating long-term relationships with complicit employees. They share insider knowledge about compliance thresholds and reporting systems. Bank complicity undermines global efforts to combat financial crime and erodes public trust. Regulators enforce strict penalties for institutions and individuals involved. They require banks to implement robust internal controls, practical compliance training, and regular audits. Whistleblower programs and anonymous reporting channels aim to uncover collusion. Strong corporate governance, ethical standards, and external oversight are essential to deter and detect insider assistance in money laundering schemes. Continuous monitoring and independent reviews help identify irregularities in bank operations. Did you enjoy watching? Subscribe if you love learning.